right, welcome to Planetary Health First, Mars Next. It is an amazing day today. We have with us two amazing superpowers. Kid you not, Lee and Marty, the $1 trillion trio, if you will. And that's not an understatement based on all their investments in their portfolio. And since we are about Mars, who knows, they might be doing healthcare in Mars one day. So anyway, a little bit about Lee Shapiro. He's the managing partner, Seven Wire Ventures, entrepreneur, accomplished executive, investing in the future industry leaders, healthcare. And his duo, Marty, is a partner at Health Velocity Capital. And then Charles Gellman, CEO and founder of Hydo Health. All right. Well, before we get going too far, we're going to just do a little icebreaker, and it's going to be the emoji dance. And the emoji dance, forgive me, getting this, what the emoji dance is, basically you are going to give us a thumbs up or a thumbs down, or it's too complicated. And I'm just going to throw out some companies, and you can give me a thumbs up, thumbs down, or emoji. All right, we'll pass. Okay.
I think. There you go.
All right, this one.
Boy, that's a long time ago. Change Healthcare now is owned by Optum. So,
all right. So, MD Live.
MD Live, another great company acquired by Cigna. Marty, you can talk about MD Live.
Are we talking about them now, or are we just?
This is just the real spitfire, real quick, and we're just going to start in a few minutes. This is our
emoji dance.
All right. I don't even know how to do an emoji. I'm going to go thumbs up. Oh, I see. We could probably do emojis.
I can. I'll give you an emoji on that. If you gave me a thumbs up, we'll give it to you.
There we go. All kinds of emojis.
All right. So let's go to the other one. Let's go to another one here. All right. So we'll just keep.
All of them have a degree of thumbs up and a degree of complicated.
All right. Well, it's complicated. I can't do both. All right. So if you want to comment, I'll be quiet too.
Thumbs up.
Yeah. Kidney care, significant.
Is there never a thumbs up by something that's been acquired?
Where are all of the bad investments we've made?
All right. I'm trying to go through them. You guys have done a lot. So
we actually spent a lot of time. Yep. We actually had acquired Mises US, and it was a transformative acquisition for Allscripts. So great deal. McKesson's a powerhouse in oncology because of Vantage and iKnowMed and a few other assets.
Yeah. First investment we made trying to help manage the cost of specialty biologics administered on the Part B side of medical spend. Still a huge challenge in our country. Awesome. And wonderful business we're partnered with now doing the same. It's complicated. Vericare provided behavioral health care services to patients in nursing homes. Huge need, hard business.
All right, we're getting there.
Click Therapeutics just received approval from the FDA for Rejoin, which is going to help individuals with major depressive disorder. Great team, wonderful company, big thumbs up.
Awesome.
Tivity Health, my gosh, I was on the board of Tivity actually before prior it was Healthways. I'm doing a lot of work to help seniors, now privately owned. But when I was there, it was a public company serving millions of seniors, helping to keep them healthy and exercising and creating social bonds. Senior Connect was a SPAC that I was on. We were looking for companies to acquire. We were smart enough not to ever find one. And so we wound down the SPAC, but a wonderful team that I had a chance to work with there.
On shift.
I'm finally getting the hang of this. I feel like I need a redo on the first ones. I thought we were literally just doing emojis. OnShift, wonderful company, wonderful group of people helping nursing homes and assisted living facilities and senior care facilities manage their labor costs better, more efficiently, and enabling them to deliver better patient care in the process. It was a great company converting from paper and Excel to the cloud. Clear Data Networks, wonderful investment helping healthcare with the migration to the cloud and cybersecurity.
And we have a number of companies that have used it, and I agree.
Oh, great. Array Behavioral Care, partner company of ours, based in New Jersey, providing a variety of telepsychiatry services, addressing acute shortages, bottlenecks, quality challenges, and cost challenges for hospital emergency rooms, primary care clinics with telepsychiatry needs, FQHCs, prisons, jails, Native American health clinics. Artera, one of my favorite companies from a product standpoint. The thesis is kill the telephone in healthcare. Healthcare uses too much phone. It frustrates patients. It is expensive. The people on the other end of the line are often miserable. This is an intelligent, automated, text-based solution for providers that can convert any clinical or administrative phone to text, secure or non-secure. Healthcare needs more of this.
Awesome.
IBX Health, another company we've invested in that's helping to address high-cost specialty drugs processed on the Part B side of the medical spend. Probably the most impactful business I've ever been involved with. I'm actually also a patient. It's my hair club for men company. They deliver high-cost specialty drugs in low-cost settings, Class A retail environments, where they treat me and my referring physician and his or her staff like customers. Great business.
Clover Health Medicare Advantage Plan. I've been on the board since they de-SPACed in 2021. It's a technology-powered Medicare Advantage plan, really helping providers to understand what needs their patients have using something called Clover Assistant, and has some of the best managed costs in the industry. While other companies in the Medicare Advantage space were reporting record costs, Clover Health showed profitability last quarter. Parsley Health, helping individuals with complex chronic conditions get diagnosed more quickly and gain the services that they need faster. Today, we have a challenge in primary care with an average visit lasting 10 minutes or less. Parsley Health is there to help provide the diagnostics that allow us to get to the root cause of someone's problem and get them treated more quickly. Override, a very early stage company that we provided a seed investment in that is helping individuals with chronic pain to manage their experience. We're fortunate that it's led by a great team, Jenny Shulkin, who herself has suffered with chronic pain, and her father, Dr. David Shulkin, who learned a lot about chronic pain when he was our 9th Secretary of the Veterans Administration, serving our veterans community and providing them with resources as opposed to just opioid medications to manage pain and creating a generation of addicts. He turned that around and they had great results.
I think we're going to need to go back to the thumbs up, thumbs down real quick. All right. You guys have invested in so many and been involved so much. So I don't want to leave off any of these.
Folks Health, providing sensitive care, community care to individuals in the LGBTQIA+ community. Payzen, solving the affordability problem in healthcare, providing every consumer with no interest loan to pay for their healthcare costs. Jasper Health, providing guidance to individuals who have a cancer diagnosis and helping them better manage their disease, hopefully to remission. Home Thrive, working to provide the ability for the unpaid caregivers in this country to manage the needs of their loved ones and help them live at home independently.
You guys pass. I tell you, it's awesome to see a venture capitalist know their pitches better than the actual venture startup founder. So awesome. I'll stop there. Where do we go? Charles, do you have a question? Marty, Lee, where'd you like to go? Because we're not on Mars yet.
I missed the whole point of the exercise at the start. I was like a deer in the headlights.
Don't worry.
What I will say this, Michael, is that you can tell from both Marty and I that we love all our children equally. And when we go into these companies, we go in with conviction. I mean, what you see, Marty's a great investor, and he puts a lot of his time and effort, into helping build these companies. And the reason why they've been successful is because of the insights that he's able to add, not just with his capital, but with all the experience he's had in investing in these great companies.
Yeah, I will apologize. I've been really excited with the John Mulaney show where no one knows what the heck's going on. And so I feel like, Marty, you don't have to apologize. My show is all over the place. So it's not your fault. So it's totally on me.
I've got massive amounts of ADHD, so this will work wonderful.
That's perfect. I think we should kick this thing up with another curveball. So you guys are probably pretty familiar with the largest acquisition in the portfolio, Livongo, and the merger with Teladoc. So I think, a lot of folks have been talking about this universities in regards to the acquisition, the implementation, the merger, and where they're at now versus what happened, a couple of years ago when the market was pretty hot. So from a managerial standpoint, if you had the opportunity to help guide the company now, but had the knowledge what you have now a couple of years ago, is there something or a different insight that you could have given the Teladoc executive team to kind of redirect the company in a different way where maybe they would have hit the revenue expectations or hit what investors' expectations were for the merger?
Well, so, I mean, the merger had great industrial logic. What Teladoc was doing was they had a leading and still an industry leading telehealth platform. Livongo put the health in telehealth. What we were doing is providing information that better informed the provider about what the nature of the needs were of the individual that they were talking to. So there's very little that I can diagnose about Michael just looking at him, here on the screen. There's a few problems that I can highlight, but the fact is, if I knew what his blood sugar was, if I knew what his weight was, if I knew something about his blood pressure and the like, I could do a much better job helping him. And that information was information that we were capturing and using to guide individuals in their care from a Livongo perspective. The telehealth market, it's not limited to Teladoc. Many digital health companies that went public in the same time frame as we did and others. You have to remember that even after we closed the merger in October of 2020, the Teladoc stock ran by probably another $100 a share beyond where we closed in October of 20. And then the market changed from a growth mindset to a value-based mindset. Multiples turned down, but they still have many aspects of their business that are quite important and serving a number of people. I guess what I would say in terms of advice to the leadership team there now is to make sure they're listening to their customers and ultimately to the end users in terms of what they need, and to build closer relationships and to do more to build out longitudinal care as opposed to episodic care, which is, I think, part of the value that we'll see from coming from virtual care going forward.
Can I weigh in here? So I was
absolutely.
involved at Teladoc from 2009 to 2016. So I was not involved for a long time. I dropped off the board about a year after it went public. This is, I believe, very counterintuitive, and it's very disappointing to me. But I think that the pandemic was actually the single worst thing that could have happened to telehealth in our country, to that telehealth sector in our country. And the reason as a tool for delivering lower cost, more consumer oriented healthcare. And the reason I say that is that before the pandemic, if anyone wanted access to reimbursed telehealth, they had to go to one of four platforms: Teladoc, MD Live, Doctor on Demand, American Well. Those were the only four companies, or the primary four companies, that had reimbursement relationships in place with the major employers and the major insurers in our country. And those platforms at that time were delivering cheaper care, anywhere from $40 to $50 a visit at the time. They were definitely delivering faster care, on average in less than 20 minutes, which is very different than the experience any of us have when we go to the doctor still today. And at times you could debate better care. Different studies yielded different results. My hope for the sector was and is, and this will sort of get back to advice, that those platforms could have become the Amazon of healthcare, where on your phone you could get urgent care and behavioral healthcare, which is where Teladoc started. You could get chronic care management, which I believe, and again, I wasn't on the board then, was a key component of the Livongo merger. You could get post-acute care management, and you could have connected devices, whether it's blood pressure cuffs or scales, or digital stethoscopes and otoscopes connected, and managing our health to a point. There are obviously times we need a laying of the hands in a better, faster, cheaper way. And the disappointing part of the pandemic to me, as it relates to the potential of our telehealth and the potential of telehealth in the country, is that the pandemic turned every provider in the country into a telehealth provider. So now, instead of going to Teladoc to resolve an issue for $50, I can go to, pick your favorite system in, Chicago, lead a Northwestern, and get that same visit from a doctor I know, but it's going to be $250 or $300, and it's going to be billed as a level 3 E&M code. And it's really diluted the potential of those platforms, absent, and this gets to my advice, heavy investment in product. I think for those platforms to regain the very significant potential they have to deliver better, faster, cheaper healthcare in the country, which is the holy grail for any venture investor or any investor, they've got to invest heavily in products that meet consumer demand, to Lee's point about listening to their customers, and that meet the demands and needs of the organizations that pay for healthcare in our country. And I do think there is a great opportunity for them to effectively to provide better care longitudinally, and to keep care out of the resource constrained, capacity constrained, and very expensive brick and mortar environments.
Yeah, I think that's pretty interesting if you think about, because as we transition from fee-for-service to value-based care, outcomes and patient experience and satisfaction are mission critical, and the closer aligned organizations are with that, I believe are going to be well positioned in the future. So then it also begs the question, if you have that product, if you have that design and it's aligned for value-based care, and you are maybe potentially integrated with a health plan or have that type of, risk adjustment alignment, then do you create a structure or organization that's so strongly aligned with the objectives in the future that the payer market almost shifts to align with those ultimate patient outcomes of reducing the cost, and also, the accessibility to those patients remotely in a way that just alter the way that we're currently spending money within the hospital system or the ER or the typical clinic visits.
Charles, I mean, you're right, but when you think about it again from the health plan perspective, virtual care, kind of the screen, whether it's on your phone or on your computer or tablet or otherwise, it's multimodal, right? And so they're thinking about what is it that's being done to offload risk. Marty mentioned you've got to provide better access. You've got to make it easier for people to get care. You've got to do it in ways that are more affordable. So, 70+% of individuals have already experienced multiple telehealth visits, and many people prefer it and look for it as a way that they can get access more quickly to their provider. So it's not going away. And I think these companies are still going to be really important and significant players, but they also have to be thinking about what can they be offering other than a network of providers that just happen to be sitting at a computer. But how is it they're going to be able to manage costs in a way, Charles, to your point, that provide a much better, not only experience, but a much better cost for who's ever at risk for the cost of care.
And that's really challenging. It's we spend a lot of time looking at telehealth businesses. I think we've got a few telebehavioral health businesses in our portfolio right now, one of which is working off of a traditional fee-for-service model, but those are hard business models. You've got to, you're paying clinicians, I don't know, leave 60-70% of your revenues, and you've got a limited amount of incremental gross profit after that to do clinician recruiting and clinician training and onboarding and quality oversight and retention and billing and collections and bad debt. And, so many of these platforms are priced less expensively than a, pick your favorite system in San Francisco, UCSF or Sutter or Common Spirit or John Muir. And at that at that lower pricing, they still have to pay the clinician, and you have to get it to huge volumes to build an interesting, sustainable business. And so I do think the sector over time, through product enhancements, is going to have to figure out a way to capture more value-based pricing based on their ability to deliver true, better, faster, cheaper care. And the better is probably the most important part there.
Yeah, Marty, just to riff on that for a moment, we have a sense there are many public health systems in this country. You can see how low their margins are, based on the investments that they've made, the costs that they have for providers, escalating costs, for providers and nurses. Virtual care is not immune to that, right? I mean, what you're creating with the technology is some leverage. So rather than 3 or 4% margins that you see in-person delivery systems, you might be at 15 to 20%, on the virtual side. But to the point is that if you're able to capture more of the value stream, you should be able to move that up better, because you should get paid something more than that, because you're actually reducing the cost of care longer term, and you should capture that in a value-based arrangement. But just from a delivery standpoint, you're doing somewhat better, but it's still not a super profitable business when you think about the cost structure that you have to have in order to be able to provide it in a virtual framework as well.
Well, and think about it this way. And you're the former CFO, so you can do math better than me. But let's say you wanted to just get to a $10 million profit, which probably doesn't justify at only $10 million, doesn't justify raising a lot of expensive venture capital. So if you're running at a 10% margin instead of a 4% margin, and you're getting paid at $100 a visit, how many visits do you have to get to $10 million of EBITDA? Was it
right?
100? Right. Help me with the math there. What is it? You got to have 100 million of revenue. You got to have 100 million of revenues. Hey, you got to have 1 million visits. That's a lot.
1 million visits.
And you've got to drive customer acquisition, which may challenge your 10% margin. They are businesses absent value-based care, they are businesses of pennies and nickels.
So I know that topic kind of is venture capital exits, acquisitions, and challenges. Just kind of want to restructure. Are we seeing a reset? I know, we're starting to see big investments, big raises. Where are we in the big grand scheme of things? How are you guys feeling as a venture capital with the capital markets and everything?
We're early stage investors. So, out of most of our funds, we're seed and Series A. A lot of tourists have left the island. We had a number of private equity funds and hedge funds and the like that were flocking to the space looking for returns because, money was free and they were just driving returns any place they could. Now they've kind of left the sector. So what you find are, firms like Marty's and ours that are still involved and engaged. I'd say that, from an early stage standpoint, there's still a lot of great company creation going on. There's many different problems and challenges to be solved. We have a later stage vehicle that we've been investing out of. One of our portfolio companies, Transcarent, just raised $125 million. And we were a co-lead in that round out of our growth vehicle because they've had significant progress and great growth with a fantastic team. And they're gaining meaningful traction with the market that they serve. So you've got a little bit of that barbell, but I would say that that's not, too unusual. And we feel, good about the prospects for the companies that remain in the market. There are some that are much later stage that raised at a pretty high valuation. And with the public markets being closed, they've got to find ways to kind of stretch the capital they have or think about alternative exits. Marty, what do you think?
I'm gonna turn this into a quiz. Michael, I'm gonna take the mic from you. So I got started investing in 1997, right as the .com bubble was starting to peak. The luckiest thing that happened to me over the course of my career was that I did not have a checkbook during the .com bubble. I was just an associate, and I got a checkbook in 2000 right after it burst. I am looking at median vintage year venture capital fund returns from 1998 on. So what do you all think for a fund that was formed in 1998, what do you think the median fund's IRR was for their life?
9.5.
All right, 1.1%. So these were seeds that were planted as things were getting hot. Some of them were bad ideas. Some of them were good ideas, but they got overcapitalized. And remember, there are two things that impact our returns. One is what's our pre-money valuation. The other is obviously how much capital did they raise, and then you divide that by the amount the company sold for or goes public for, and those are your returns. So 1998, the median firm returned 1.1%, combination of silly ideas in a bubble environment and overcapitalized companies. All right, so the bubble burst in June of 2000.
Now look at 2003. Now look at 2003.
Hold on. You can't steal my thunder. So the bubble burst in June of 2000. What do you think median returns were in 2000? Bubble burst, things are getting better, valuations getting more normal. Take a
1.2.
Well, I'll let Charles guess.
Negative 1.5%.
Yeah, that's
negative 1.5%. 2004. We're 4 years after the bubble burst. Party's long over. Where did things rebound to in 2004?
Let's go 2%.
Charles, this is yours.
2%.
0%. So not until 2007 did the median venture fund raised in that year, formed in that year, 2007, the median return was 9.4%. And so,
Hey, I was there just 10 years, 15 years.
I mean, you went from 1999 until 2007. You had 8 years where venture didn't justify its existence. Now, the public markets were also terrible then, which is very different than they are right now, at least. But the point I was trying to make from that data is, in my experience, these hangovers, they last a long time. And it's a combination of, silly ideas, products and not companies, companies that deserve to exist, but 10 companies were formed in a sector that can support one or two of them, and they're bashing each other's heads against the walls trying to compete over the same customer base. Good companies, but overcapitalized and or overvalued relative to the realistic, reasonable, conservative size of the market opportunity and realistic and most probabilistic exit. Coupled with that, and those companies take time to work their way out of the system. Coupled with that, right now, with the exception of last year, and it's only marginally less than last year, we have more dry powder in the venture sector, in the venture capital sector, than we have ever had in the history of our industry. So you've got massive amounts of dry powder. What we're seeing in the market, Michael, are, you're starting to see companies that don't deserve to exist, go on their way, which is good for everyone because entrepreneurs have an opportunity cost too, and we want them working to their most productive and useful purposes. So you've got some going out of business. You're seeing some asset sales, some bankruptcies, some suboptimal mergers. But because of all of the dry powder, and more than half of that dry powder was raised in 2022 and 2023, the companies that are interesting are still commanding valuations that are going to be hard for them to grow into and generate returns that we would historically associate with venture capital, in our opinion. And in our opinion, this hangover is a 5-6 year process, and we think things start to normalize, end of 25, early 26. That's sort of our take on the market. It's interesting. We have not made a new investment in 15 months, and it's very frustrating. We're passionate about healthcare innovation. We're passionate about our mission of generating strong financial returns while contributing to a more affordable, sustainable, consumer-friendly healthcare system. And we're just having a hard time of it.
Is there something?
We invest at a different stage than Lee and his colleagues do.
Marty, when you actually start to assess investments that fit your portfolio, is there a high-level criteria of what you're looking for, or specific standards or metrics, or is it more team-based or revenue? What's kind of the overall mix in order to hit that bullseye for you guys?
Oh, how long do you have?
We got probably a good bit.
In 60 seconds or less.
No. It's a longer question than that. We've got a wide lens, but are looking for an awful lot of characteristics within that wide lens. And I would say, for what it's worth, we've been very fortunate to have been affiliated with a number of, very large, very successful businesses over the course of our careers that generated a lot, very strong returns. We have not made that many mistakes. On the downside, we have not made that many mistakes. I will say quite candidly, we've missed a lot of great companies on the upside, based on our view of the market.
What was one you missed?
We missed Athena. We missed IPC, the hospitalist company. We missed Definity. What else did we miss? We missed tons of them.
I was going to say, the nature of our business is we miss a lot more than we find. And from my perspective, especially investing early, we have a number of companies that, we invest in. The, founder is still looking for product market fit. They're pre-revenue in some cases, and they just don't make it out of the starting gates in spite of the great vision and intentions they have. So we just kind of expect some of that as part of, the process that we go through. We're betting on people mostly because we're coming in so early. We know that whatever it is that we're investing in, the initial plan is going to change a few times before we finally get it right and get into the market. And with that in mind, we try to find people who are resilient and persistent and driven to succeed. And sometimes that combination, leads to a great investment that has a wonderful exit. But we've, taken some founders where, valuations were, a few $1 million at the time we invested. So we've got some room to, let it run and try it out. And when it gets to, $200, $300 million in valuation, that's a nice day at the office for us. But sometimes, you invest in a company in an early stage, a few $1 million at an early stage valuation, doesn't make it. And so we've got to offset the losers against the winners.
Do you do a good job, Lee, of do you do a good job? So we invested a different stage. We are looking for product market fit. We invest after there is evidence of product market fit. As I reflect on my career, and I've gotten better about this over time, the biggest mistakes I've made in my career, and I've seen my partners make in their careers, are selling good businesses too early. You do all this hard work, a company's working, and then you flip it to a private equity firm and they don't do much of anything. And 3 years later, it's another double or triple for them, which would have been even more off of our low cost basis. It strikes me that there is an awful lot more upside and room to grow, as you said, at the earlier stages, but that really works if you're willing to, one, starve the companies that aren't working, as opposed to continue to throw money at them, and B, at a board level, take a very realistic perspective of how large can this business ultimately get, so that you're not overcapitalizing it for everyone relative to the high probability exit value. And that's where we see, and I'm not speaking to Seven Wire specifically, but I think there's a real skill set there. Have you all refined that?
Well, we're still, every day we're learning, and we're still in the process of refining it. But, your comment reminds me of the joke about how do you make a small fortune in venture? You start with a large one, but you keep funding all the companies that maybe you should have stopped funding somewhere along the line. And
I never heard that.
But what we find is that because we've had a high degree of operational experience, all of my partners and I have built businesses. We've taken multiple companies public. We've been in situations where we've seen kind of the ups and downs in the business. That allows us to bring a perspective to the boardroom that is one that, at least if the founder, wants to learn from some of those mistakes that we've made, they can. Sometimes they want to make their own mistakes, and that's great. But we do have a sense from the types of things that we've seen in certain markets, trying to sell to certain types of customers, that allows us to maneuver through some of the challenging cycles that you've seen. And on this notion of, selling, the business, too early, we've been fortunate to have the conviction around some businesses that, have received some offers early on. And, we've been able to, with ourselves and some of the other partners that we invest in, give them some time to run so we can get to an exit that allows us to achieve a little bit better value. Not always, I know we've sold a couple too early as well, and there have been some that, frankly, when we look back, the idea was fantastic. We just didn't have the right team in to run it, and we didn't give them enough capital to kind of get to the place where we could bring in that team that may have been able to make it into something that would have been a home run. One thing we haven't talked about, especially if we mention exits, acquisitions, and challenges, is the public market environment. And Marty and I both look at the markets and think about what is the IPO market for companies, because that does have a meaningful impact on valuations as companies do have the opportunity to exit. And we've been in a situation where we haven't seen an IPO in the sector for the last couple of years. This year looks like, even though there's a few teed up, it's still going to be a pretty slim year for that. And Marty, you had mentioned about, end of 2025, but what's your perspective on when the IPO market turns around? Because I'm feeling like we're definitely going to have to wait for some shakeout post-election before we start to see much in the way of activity, especially with interest rates sitting where they are.
If I were a public market investor, which fortunately I'm not, because every time I've tried to do it, I've just proved myself horrible. The very few times I've tried to do it, I've proved myself horrible. I largely just invest in ETFs. Look, I think healthcare is very hard, and Lee, I'm sure you agree. We've spent our careers aligned around the same mission.
I'm as old as Charles, and look at all this gray hair I have from being
I can pull up this slide from our annual meeting, which was 2-3 weeks ago, in a second, but let's just say that maybe there were 40 digital health companies, next generation healthcare software services companies that went public 2019 to the present that are still public. I think like 2 or 3 of them are still trading above their IPO prices. And so if I were a public market investor, which fortunately I'm not, I don't think I'd touch the sector. And if I did, it would be very, very company specific. And so, Lee, as I think about it, and again, I am not a public company investor at all, but as I think about it, I don't think our sector, I don't think the window is going to reopen for our sector until there's another, I'm not going to call it bubble, but extraordinarily robust environment. I think the window will open for great companies with unit economic models that are clearly working, with a high degree of consistency and predictability, and very large market sizes. But I'd be surprised, assuming the public markets are rational, if there was a lot of appetite for businesses that hadn't demonstratively proven those characteristics. I could be complete. What's your perspective? And I would also say I tend to, I could see I could find a cloud in a perfectly cloudless sky.
So the one other thing we haven't said, now almost 45 minutes into this conversation, is AI. And there could be a couple of breakout companies that come to market. We've seen massive funding, mostly from tech investors, not from kind of the traditional healthcare investors like us, where there may be some things that break out from a market standpoint at meaningful valuations that set a watermark that might allow some other companies to follow.
I think that's a great point.
Right, because that's the new tulip bulb, of kind of the current market, and it's not quite sock puppets and pets.com, but we are certainly seeing significant, meaningful developments there. And by the way, I'm joking about it and being a little facetious, but it's real, and it's going to create significant opportunities to change some business models. And with that in mind, I don't think healthcare is an exception. So there could be some things that break out in that regard. I'm just not aware of any that are kind of close to thinking about doing so in public market environment, because they've been able to raise so much money from the dry powder you mentioned, being private. And so that may come sometime next year.
Hey, Lee, Gen AI aside, and I agree with you on that point relative to both potential and hype. When do you think I'm gonna wrap it all into a category of next gen healthcare innovation, software and services? When do you think the window reopens?
I think it's Q3, Q4 of next year.
Yeah. And do you think it's selectively, or do you think it is company specific like I do, or do you think it's?
Yeah, no, I agree with you. I think it's company specific. I don't think that we'll be back into an investor mindset that's looking at growth and growth at all costs, so to speak, and willing to tolerate meaningful losses while companies are building their businesses. I think that you're going to have to see some of the market fundamentals and either a strong path to profitability that's well understood, or companies that have already built the machine, have the business model, and are demonstrating profitability, are going to use the capital to grow into new markets, where there may be an investment period, but you can see the path for how those markets become profitable. Michael, we've hijacked the questions.
No, hey, you're like great founders. That's what, when you get a great founder, it makes your job easy. You guys this is great.
Look, left to our own devices, Marty and I are going to start talking about the Giants and the Cubs.
And the Knicks, right? And the Knicks, right?
Yeah, we can move to the NBA, but neither of us have a horse in that race now.
Yeah. What do you think about the health plans and the payers actually starting to fast track some of the innovation and product enhancements in the marketplace? Because as their margins shrink and as the costs continue to increase from a hospital and a provider standpoint, do you see some type of innovation occurring from a payer standpoint or a government standpoint where they're incentivizing, more accountable care organizations or value-based care technologies that bring to what Marty was saying before is, enabling access, bringing care faster, making it accessible, but also convenient within the home? Do you see more products and innovation being pushed into the home because of the demonstrable savings that can occur?
Lee, you want us to start with that?
Yeah, I'll jump in. I guess I'm not as sanguine about it. What I see happening on the payer front is that, let's look at government programs on Medicare Advantage and managed Medicaid. There have been significant reductions in reimbursement rates. I think we're going to see a shrinking of some benefits from some of the leading, health plans as they look to manage their costs. So a number of the innovative solutions that they were offering before will probably be left on the cutting room floor as they think about the types of benefits that they're going to be delivering going forward. Commercial insurance is a little bit different, especially in the self-insured employer market, where the plans are administering plans for the large self-insured employers. We can't be spending 20% of our GDP on healthcare. Someone had joked that, kind of General Motors was a health insurance company that also made cars, because like the huge amount of cost that they have in providing healthcare for their workforce. And we have to find a way to kind of reduce that trend for them. So they will continue to be innovative and looking for solutions that are doing that, including value-based care solutions. So I think we'll see more innovation on the commercial side, but less so coming from the government. And then, government direct spend, what we see are just, program du jour, new name du jour, kind of pilot du jour change of administration, I just don't see them driving the innovation. I am certainly encouraged by what ARPA-H is doing. And they've got a great team, but think of it as a development shop that's looking at innovative solutions that maybe others are going to scale, but less so in terms of what the government might do. Marty, what do you think?
Yeah, I think, Charles, on the government side, post ACA, we've been in an environment where the government continues to try to tweak around the edges with varying degrees of efficacy and scalability. And I think that will continue. But as Lee mentioned, it's sort of hard to build a business around because, one, it's not easy. Witness all the value-based care companies that have not succeeded so far. And two, the rules can change. On the health plan side, we are seeing all of them show a keen interest in generative AI and ways to apply that, in particular to the administrative side of their businesses. I think we will see that. We will see more and more of that. I think that historically and going forward, partially because some of the challenges they're facing right now, a lot of the innovations around care delivery that are relevant to the insurers have historically been pulled through by the employers. That's been the pattern for the past, at least 15 years. And I think the employers are a little bit tired right now, and they bought a lot of new products and new solutions during the course of the pandemic with differing degrees of efficacy and ROI, and with the exception of a few categories. And, I think they're taking a breather. I will make one other comment related to sort of the market for innovation, the buyers of innovation. And that is, I had a really interesting conversation in February with the senior executive at, one of our nation's very largest health systems that was coming off of a, close to a break-even year. And I asked this executive if he thought that, given their financial performance and financial challenges, which are not unique to them, they would slow down on the purchase of innovation in their organization. And he said, no, we can't afford to. We are looking at innovations and for innovations and adopting innovations that allow us to automate administrative functions, drive efficiencies, make our workforce, which is both quitting and costing more efficient, happier, and more productive at their jobs. And that was actually really encouraging for me to hear that, notwithstanding a more challenging financial environment for health systems, they actually think that technology and innovation is the answer and not a part of the problem. I think they'll be, looking for real hard ROI. You mentioned Payzen during the emoji section of our podcast, which I royally screwed up. But, Lee and his work with this wonderful organization called Payzen, that's, one example of an innovator that is helping health systems address those problems.
Well, Marty, I'm encouraged with what you just said. It sounds like technology can be our saving grace here, I guess. And any takeaway on Lee or Charles as we got about 2 more minutes as we're wrapping up. I feel like we've covered a lot of ground here today.
Well, I'm also with Marty. I'm encouraged that technology can solve meaningful business problems in healthcare. We've devoted the last 30 years to investing in technology that will fix some of the broken process that we see. Healthcare is too difficult, too confusing, too challenging, and that adds a meaningful amount of cost and burden. And what we're finding is that healthcare is not evenly distributed, but technology can help level the playing field and provide better services to more people, meet them where they are, and do great things. And so, we believe in staying the course. We think it's hard. Marty mentioned that earlier. It is hard. It requires a lot of persistence, but what makes me encouraged is the fact that you've got people who are willing to listen, Michael, to your broadcast, and Charles, the work that you're doing at Hido. It takes a village to make these changes, and it's going to be an effort by all of us, including those listening today, to be committed to helping kind of change the system in a way that allows for better outcomes at lower costs. And I think that at least we believe that we can do that, leveraging some of the great innovators that we see and who are members of kind of our portfolio of terrific companies.
Well, this has been an awesome time today on Bring a Friend podcast, Planetary Health First, Mars Next. And if we're not friends, we are really good friends now. I'll tell you, we uncovered a lot. And until next time, friends.